Vikash Kumar Jain of CLSA joins us. Let's take our conversation forward and understand what his market view for 2023 is. Good morning, Vikas. Happy New Year. Your note,
Good morning. Thanks for
tit-
having me.
your note title India Themes 2023. I'm going to read the first line of this note. The outlook for 2023 is weak amid high valuations and softening headline macro data. So the first line captures and says it all that this year we should not expect anything spectacular from Indian stock markets.
That's correct. I think this will be the year when the biggest theme will be migration of money away from equity into debt. This will possibly be true both in India as well as the US. So, of we, one of the analysis that we do is try and compare equity valuations in relation to debt. And we do this across the top markets. We find that US and India equity is significantly more expensive than that. And in fact, in case of US, it's the differential between earnings yield and bond yield is at at a level which it has not been in the last 15, 16 years or so, at least. In India also, we are well above what I would call the danger zone in terms of that differential. Uh, Last year, investing in debt would have been suicidal to a large extent because you knew that central banks were raising rates and that could lead to capital loss, particularly investing in duration debt. I think some point this year, as the confidence on terminal rate rises, maybe sometime in the middle of the year, maybe sometime in the next couple of months, that will be the point where debt investors will feel a bit more secure about downside being less. And that's the point where we see a big shift away from equity into debt. So I think that's really going to be the big theme at a point when, you have, if we were to look closer home in India, uh, over the last 6, 7 months, trailing 12-month returns of Nifty for almost 80% of the days has been less than the simple SBI fixed deposit that you can get out of it. I think this is itself going to cause even retail money or people who are putting money in mutual funds to look at debt more attractively. And I think that all of that is what will clearly be one of the biggest themes for this year.
Let me be a equity bull and say, very rare in the history of Indian stock markets, you've had 2 years of no returns. Last year was like 4%, almost no returns. If the outlook what you've indicated, if holds true, that means 2022 and 2023 are going to be 2 years of no return. Now, history also tells us that it has rarely happened in the past.
Yeah, that's a fair question. But if you look at it, last year itself was a very rare year. We saw record FII selling, but it was absorbed by the market. So I think historically, if you were to ever see significant FII selling, what used to happen was market used to correct and valuations used to become more palatable. And by the time we ended the year, the next year, people were looking at equity more attractive. But I think the way that selling has got absorbed, perhaps by domestics, this whole process of derating is way more gradual. So the last 2 years, in fact, if I were to like calendar years, we've had a PE derating in both the years. Last year, we started the year with a PE of about 21x or so. By the time we ended the year, it was 19x for Nifty. But still, despite that PE derating, it's far more gradual. If you were to look at historical average multiples and given where yields are, multiples need to be significantly lower than that. We will have another year of derating maybe. And this time I am not sure if it is going to be so gradual because if you were to look at what held that or what made sure that the movements were more gradual or absorbed the FII selling or the domestic money coming in. And over the last few months, we've seen that itself waning off because of the reasons that I explained that, perhaps debt is looking more attractive. So with that, I think maybe the actual impact of FII selling has not been felt last year. That was a unique year itself, which kind of also tells that, the market is far more deep, far more matured. But that is why, a lot of those examples of history, we need to be a bit more careful about. The other thing about history is that in our case, if you were to look at where the world is right now, where the US market is, we are looking at 50-year cycles of where unemployment has gone down to where inflation is, etc. Our market, we do not have data for that long. We are just looking at 15 years and trying to say that, okay, 15, 17 years, this is what has happened. Because, so essentially, our available history in terms of data isn't really that long, given where cycles are taking us globally.
Interesting. Um, I'm pretty candid also, I must say, Vikash. But tell me, so in this lean patch that we're going to see of, further deratings, as you called it, uh, for pure equity investors who do not want to look at fixed income or debt, what should they be doing?
Well, I think the name of the game should be first, we should lower our expectation of returns. Okay. This is what we typically end up people, seeing is get colored by what has happened over the last few years and expectations do not come down. If we lower our expectation of return and think about it, that this could be a tough year where capital protection and preservation will be the key part. And hopefully, by the time the pain ends, we should have our capital shouldn't have got run down, so that we can play the next leg up. So that is why, since you're reading from my note, by the time I end the first pair, I'm pretty clear that the bias is clearly value and defensives. So I think that's what one needs to focus on. This is going to be a year when one should not be very adventurous about expectations of return. And once one is able to bring that down, then they can look at defensives and some of the stocks where they can possibly hide, some yield plays, value play. Value, anyways, is a theme, I think, is back in a big way. And I think it's here to stay. So, that's how I would recommend people to look at this year.
But what would qualify as defensives, Vikash? And would you still qualify the traditional IT, FMCG as defensives and pharma included in that pack?
Well, that's a great question because, I think when we say defensives, there is a traditional understanding of defensives. But what I would want to bring to the picture is what is changing in the world now. What is changing in the world versus the previous decade is a cost of capital is going to be an important concept. In the previous decade, that was not the case. When, a large part of that period, interest rates were abysmally low globally. If that happens, then many stocks which are traditional, defensives and value, but are trading at, we have a whole host of consumption stocks which are trading at earnings yield that is just a reverse of PE of anywhere between 1.1 to 2% at a time when US bond yields have gone up to 4% or so. That is something which we are not so convinced about. So, despite the fact that we say defensives, we have no consumption stocks in our portfolio, practically zero. In fact, uh, I would say that if you look at our portfolio, and that's something where I try and, although it's something which is more of a recommendation, I try and look at it very closely and try my best to do well over there. We've been quite lucky. We've started this portfolio from Jan 21. We've outperformed every quarter. So I'm just trying to tell you, all of the last 8 quarters, a total return of about 88%, total outperformance of something like 55 percentage points in 2 years. So I'm just trying to tell you that I am taking that portfolio, which I kind of pretty seriously. And in that, I've taken this big call that I have no consumption stocks at all. You know, because it's hard to find consumption stocks which are not overextended. I am talking of defensives, I'm also talking of a risk that interest rates could stay high for longer. Many
Right.
of these are great quality names, but these could be right in the midst of a long drawn derating process.
Long drawn derating when it comes to consumption. And yes, looking at your India focused portfolio, there's a lot of tilt on financials, insurance plays, and then of course there is a mix of IT, real estate, etc. But just let's talk about those, marquee financial names, and how you're looking at the insurance play as well for the year ahead.
So yeah, so this is a big change that we made around just before Diwali, where we added insurance. Perhaps we were maybe a few weeks early in the trade, but I'm not complaining because it seems to be working well. So insurance, I believe, given the way the stocks were completely out of flavor for a large part of last year, valuations have corrected a lot, and each one of them have perhaps seen the worst. And in terms of business momentum, also, we see improvements from here on. So valuations becoming more palatable. This is anyways the story which is part of the the long-term story of penetration improving, and at the same point of time, higher interest rate cycle for Indian insurance companies isn't a bad thing at all, because of the kind of investment books that they have. So from that perspective, uh, uh, it is what we thought was a beaten down and could be seen as a defensive. So that's why we kind of, insurance is a big overweight in our portfolio. So that's the thought process behind insurance.
Good morning, Vikash. This is Nantar also joining in on the conversation. You folks did turn cautious on the IT pack. Mid-year last year, I remember you yourself were talking about how the valuations weren't looking frothy. This earnings season, we've seen the kickoff when it comes to TCS and just the way the stocks are off their highs now. What's the call when it comes to IT by you guys?
Yeah, so we were, in fact, that's one of the things which helped our portfolio performance, because we were significantly underweight IT for a large part of last year. Sometime again in October, we closed that underweight. We are now more like neutral on IT. I think a big part of the underperformance juice for IT is gone from a long only perspective. Multiples are still on an absolute basis not very comfortable, but on a relative basis, they are pretty close to the average premium that IT trades as versus Nifty, just slightly above the average. So I I did not really have, once that has changed, I did not really have that aggressive an opinion on IT underperformance. And essentially, the big change in terms of portfolio construct would be sometime during the year, coming back to that initial discussion of when we hit the terminal rate point. What we have seen historically also in last 50 years of cycle in the US as well, when rates are increasing, technology, which is seen more as a growth space, for them, multiples start shrinking. But by the time we get into a significant recession or something, real economy stocks get impacted. And when the initial rate cuts happen, that's the point when technology actually outperforms banks. I think sometime during the year, one should be aware of this shift which could play out, where people should look at things like technology a bit more constructively as compared to banks. Not yet, but right now the simple message is that a large part of the underperformance juice in technology may be behind us.
And Vikash, I'll take this opportunity to also ask you about big word Reliance Industries. You've, of course, been tracking the oil and gas space for years now, and you have come out with a note co-authored with your colleague Vijay Gant. Talk to our viewers about it. The numbers could be released as early as next week.
Well, I mean, I'll not go stock specific, but as you suggested, that clearly that's a conglomerate that we have a positive stance on, which you're talking about.
I'll switch the argument away and say interest rates will pivot at some point in time globally. Interest rates, they act as an indicator of terminal value. I'm breaking it for our viewers. If interest rate they peak out, what are the chances that growth stocks could also make a comeback? Look, when interest rates they started moving higher, whether it is IT or fintech or consumer tech, all of them started underperforming. Now it's somewhere in the middle of the year, if interest rates they peak out, what are the chances that growth stocks, tech stocks, fintech stocks, consumer stocks, they may come back?
No, absolutely. I think that's really going to be the debate for a large part of this year. But interest rate peaking out uh, will perhaps this time be followed by a significant growth slowdown. I would say that the current consensus expectation, which is, in my opinion, being baked by the market, is that of some kind of a magical soft landing or only a mild recession. Honestly, I don't know the answer of how it will be, but given by just a look at history, and that's something which I try to look at many a times. Uh, it's tough to create that soft landing. It's been done rarely, and with this kind of change, and if you were to look at the kind of increase that mortgage rates have seen for people in the US, etc., I imagine it's going to be not easy to create a soft landing. My worry is if the pivot in terms of terminal rate happens, okay, fine, but that is followed by a severe slowdown on growth, then the initial rate cuts do not really make a difference in terms of sentiment for the market, you know. So that's essentially how does the period after the pivot play out will be able to give you that answer. Honestly, the biggest debate through this year will be how will this slowdown which is coming, what will be the shape and the size of this slowdown? I will say everything is on the table, right from the fact that it could very well be stagflationary, because the unique thing about this slowdown is this is far less coordinated globally, because you're seeing a China reopening on one side and the Western world seeing some kind of a recession. So if the China reopening causes inflationary pressures on commodity, then why this could very well be a stagflationary period which could last for longer. On the other hand, the more worrisome, the other people who are worried about say that this will all end in an ugly situation. This will be deflationary. Fed has got ahead of itself, and they will slow down the economy more than required. Or the more milder outcomes, which I think are more easily digested, maybe a more simpler kind of a shorter recession, or maybe the magical soft landing. But in none of those, unless you believe a soft landing or a very mild recession, which means the market has already absorbed a large part of the pain, would a lot of those growth stocks come back so quickly, right?
Point.
Nonetheless, whenever we get to that point of terminal rate, that is what I was saying. There will be a trade where core economy sectors like banks could start taking it a bigger underperformance as compared to many of the technology space which has already absorbed a lot of it.
Fair point. We live in a very dynamic world, whether it's recession or whether it's inflation. Well, last year inflation kept us busy. This year, I guess it is recession and inflation. Both those debates will keep us going. Appreciate your time. Have a wonderful day and a wonderful year ahead.